Everybody wants their investments to outperform the market, but most investors underperform for a simple reason. They chase past performance. Investors get into investments after they have done well and out after they've done poorly, resulting in a sizable gap between investor returns and investment returns. I'm Ben Felix, portfolio manager at PWL Capital, and I'm going to tell you why most investors underperform the market and how you can do better. Performance chasing is a persistent feature of financial markets. It explains aggregate flows to mutual funds and the flows across funds and holds for both actively managed and index funds. The resulting performance gap is between 1.5 and 2% depending on the source, and it tends to be much larger for more volatile, specialized, and speculative funds. For example, the gap was 5.3% for the NASDAQ from 1973 to 2002, 4.38% for sector funds in the decade ending December 2022, and for an extreme example, investors in Cathie Wood's ARK fund earned double-digit negative dollar-weighted returns on average, while the fund delivered positive time-weighted returns from inception to May 2023. More generally, the return gap tends to be much larger for growth-oriented funds than for value-oriented funds. Fees get a lot of attention, and don't get me wrong, fees are very important, but these data suggest that investors are losing more on average, and in some cases much more per year, to inopportune timing than they would pay to own a high-fee actively managed mutual fund. The data on flows and the impact of flows on performance should not be too surprising given the relationship between expected returns and subjective return expectations. Investors tend to have high return expectations when model-based expected returns are low and valuations are high, and low subjective return expectations when model-based expected returns are high and valuations are low. In other words, investors extrapolate recent returns into the future, so they'll be more likely to believe that a fund with strong recent returns and, correspondingly, holdings with likely high valuations will also have strong future returns, and that a fund that has done poorly will continue to do so. This will tend to be an error. Diversified funds will tend to have persistent exposure to common factors like market beta, size, and value, which will explain most of the fund's returns. When a fund's factor exposures have a period of poor performance, it drags down the fund's return, driving investors away, and pushes down the valuation of the factors, leading to higher expected returns for the fund. It works in the other direction too. A fund with strong past performance, which probably looks enticing to investors, likely loads on factors that have recently done well and correspondingly have higher valuations and lower expected returns. Timing errors occur both on the upside, that is buying after recent positive past performance, and on the downside, selling after a decline. But selling after a decline seems to contribute more to the overall performance gap, at least in some studies. I think these data highlight the importance of having a portfolio and an investment strategy more generally that you can stick with. You need to be able to live with your portfolio's volatility, and in particular downside volatility, and to avoid getting distracted by attention-grabbing recent returns of other investments. Beating the market is hard, but beating the average dollar invested in the market is relatively easy if you can avoid making the all-too-common mistake of performance chasing. Thanks for watching. I'm Ben Felix, portfolio manager at PWL Capital. If you enjoyed this video, please share it with your return-chasing friends.